Good day. My name is Tommy Ruke. If you have any questions during this presentation, we want to answer them. Please type them in the chat window. That way we can answer them as time allows, or if we run out of time, then we'll email you the answer and after the webinar is over. And we will also share with other participants your question if they're relevant to everybody. Also, if you have difficulty with the auto part of this program or any other one, please again type in the chat window your problem or call our office at 800-741-4084. We'll attempt to correct the problem as soon as we know about it. Let's recap the first 2 hours of the session. Named insured. It's important we set up the policy correctly. The business that we should set up is the business we're insuring, the legal entity. It could be a proprietor, which will end up Tommy Ruke DBA, but that legal entity is Tommy Ruke. It could be a partnership, Tommy Ruke and Beth doing business as T&B Trucking. Again, that legal entity is a partnership, which is B&B Trucking. Or it could be a corporation, Ruke Transportation Inc., or an LLC, Ruke LLC Inc. You need to put on the named insured line the business you're insuring, and you need to underwrite everyone that you place on the named insured line. You also need to remember you do not need to list the owners on the named insured line. All owners and managers are already protected by definition of the policy in the who's insured provision, so do not list the owners of the legal entity unless, of course, they are a proprietor. That's the DBA, because that is the business itself. But when you list a proprietor, you need to be aware that they could be involved in other businesses that they're sole owner. The who's insured provision we'll see later will extend possible exposure under your policy for these other businesses, even though they're not the trucking business you thought you insured. So if you have a proprietor or individual on the named insured line, you need to find out if that proprietor or their spouse owns any other business. One way to protect yourself would be to add a classification limitation to the policy, which would say all we're going to cover is a trucker's classification, no other classification. We saw that the policy pays for bodily injury and property damage if the insured is legally liable, to which this insurance applies. That's the key element here, to which this insurance applies. If it applies, it will apply, if it's not excluded. If damage is done in the policy period, payment is for the damage in the policy period. Again, here is a concern where the work itself, for example, your insured puts a tire on a owner-operator or other person's vehicle in one policy period. And let's say the policy period renews 3 days later. And 3 days later, that person who you put the tire on has an accident. And the reason the accident happened is because you put the tire on improperly. The policy has to respond is not the policy when the tire was put on to the vehicle, but it would be the policy that was enforced when the work you performed, the tire you put on, your insured put on, failed. It's in the policy period. Even though we got premium based on when it was done, the damages are paid during when the policy responds. That's enforced when the damage is done. So if work performed in an early policy period falls in a new policy period, the new policy has to address the claim. Very important to understand how the general liability and the business auto policy or auto liability coverages works together. Auto is a defined term and mobile equipment is a defined term. Basically, auto pays for damages done or paid for damages done in the business auto policy. Damages done by mobile equipment is paid in general auto policy. The key factor here is the unit license for the road. That's the key factor. Even though it meets the definition of mobile equipment, if it's licensed for the road, then it is not mobile equipment, where the damage that could be done is covered under the GL. It's an auto, which damage must be done covered under the auto. The example that is more relevant in the trucking arena are yard tractors. Yard tractors, because they're used solely on the insured premises, would fall under the classification of mobile equipment, and any damage done on the insured premises would be covered under the general liability policy of the insured. However, if that yard tractor gets on public highway, therefore necessitating it to be licensed for the road and have proof of financial responsibility to be able to operate on the road, then it would be no longer mobile equipment. It would be an auto, and that yard tractor must be addressed under the auto form. The general liability policy excludes autos, but only autos owned by, operated by, rented, or loaned to an insured. So therefore, if the insured has a garage operation, as an example we used before, and they did work on somebody's vehicle, and after that work was done, the vehicle runs out, gets away from the premises, and then the work fails, for example, the tire there, the general liability policy will address that exposure as long as the insured was not operating it, driving it, it was not rented to them, leased to them, it was not loaned to them or borrowed by them. So therefore, the garage exposure for liability would be addressed under the general liability policy. Same thing from a brokerage operation. A true broker does not operate the vehicle, they do not rent the vehicle is not loaned to them, or they borrow the vehicle that they broker the load to. Therefore, the general liability policy would pay in excess of the auto policy on the truck that they broker the load to. The other concern is the loading and unloading, which the auto policy excludes loading and unloading, and that manages or matches the business auto exclusions and truckers and motor carriers exclusions for handling property or movement of property by mechanical device. Where the general liability policy does not pay, the auto policy will. Where the auto does not respond to moving a property, then the general liability policy. Very simply, the general liability policy excludes damage done by movement of property before the move starts and after the property is at final destination, where the auto liability policies address the damage done from the movement of property before the move, excludes damage done from the movement of property before the move starts and after the property is at the final destination. So as it's sitting there ready to be picked up, let's say, for example, your insurers are picking up something with a hand truck. If it falls down before the insured starts moving it, then that's GL. But as they move it from the location they pick it up to, onto their truck, off of their truck to a new location until they get to the final destination, it will be auto. But once they again get to the final place, the property's to be delivered, and then again they stack the items up, they fall down, then that becomes general liability. Very important to work these things together and understand how they work together. This session we're going to look at the other exclusions we have. The exclusion G is what we defined in the earlier section 2 that I just went over briefly. We remind ourselves again that the insurance agreement states that the insurance carrier will pay if insured is legally obligated to pay damage to which this insurance applies. It applies if it's not excluded. So let's look at the exclusions. Exclusion 2, which is the first exclusion. This excludes bodily injury property damage expected or intended from the standpoint of the insured. However, and it does read on beyond that. That's the wording you also found or would find in auto liability policy. But the general liability policy takes it one step further. It says this exclusion does not apply to bodily injury resulting from the use of reasonable force to protect persons or property. Two examples of this as we go through this or look at this in a little more detail. The first off, most court systems have said that even though it's an intentional act, if it was not intended injuries, you would still have to pay. For example, you're insured trying to get to their truck, pushes somebody out of the way in order to get to the truck. Just because they're impatient, they run down to. Their intention was not to hurt the person that they pushed. Their intentions were to get to their truck. But as they push that person, that caused the person to step in a pothole and cause that person, when they step in a pothole, to wrench their knee, causing damage to their knee, and now surgery has to be performed. The general liability policy for the trucker who pushed the individual would in all likelihood have to respond, because even though it was an intentional act pushing the individual, they did not intend to hurt their knee. Another example would be protection of personal or property. For example, had a case, one of my insureds, a beer company, was delivering beer on Fort Myers Beach. As they delivered the beer on Fort Myers Beach, someone came and took a case of beer off of the back of the truck. That driver got their case back. The person they got it back for was not in as good shape as they were before they took it, because the driver aggressively got the case back. That person then thought the driver was overzealous and therefore sued for their injuries, and the policy, that general liability policy for that beer company, would respond, because the reason that injury happened is because they were protecting or getting their property back. Two exposures that a trucker might have in this area, besides making sure that their truck is not broken into, property not taken off of it, or as I said, being aggressive, is if they have dogs or guns. Major consideration. Why does your insured have guns and guns? So, consideration. It will not exclude it if the intention were not there. But intended acts leads to unintentional results. That's the key part. It's not excluded if intentional acts was intended to protect persons or property, getting a case of beer back, as long as it's reasonable. And that's up to the court system, because once the suit's there, then the argument would be you cannot collect or it was not reasonable. This gets to the problem that why does insured have dogs on their premises or other animals? In most cases, to protect the property on the premises. Therefore, if those dogs bit somebody as they were entering onto the premises, then that dog bite was an intentional act. However, it would be there to protect the property on the premises. So therefore, the general liability policy of the person who owned the dog, who's owned the premises, would pay. If the gun is used to keep someone from stealing cargo, stealing a truck, or coming on your premises, and that gun shoots somebody and hurts them, again, that person they hurt could attempt to sue to collect damages done. And in those cases, that would also be covered because it was there to protect the property. The key here is the dog and or the guns in the truck or not? Are they riding along with them or not? So to this end, it would probably be useful to look at exclusions where we'll exclude animal bites and exclude guns or damages done by guns by the insured. Again, those things exasperate the possibility of having to pay a claim, and you might want to consider that, or if you're a retail agent, you might want to be aware if your insurers do these things, that the policy that you buy might not address it because of an animal bite and or a gun exclusion in the policy. Exclusion 2. This exclusion assumes liability is assumed under a contract, but it does not exclude liability that is an insured contract. Therefore, the key to this is not the exclusion where we do not pay for bodily injury or property damage assumed under a contract, but what is covered, and that would be items defined in the definition 9 in the policy of insured contracts. It has the miscellaneous contracts, lease of premises, sidetrack, easement, and elevator maintenance. But then it goes on, and this is the key wording here, the broad form contractual. It says, and this is not excluded, any part of a contract or agreement pertaining to your business, including indemnification of a municipality in which you assume the tort liability of another for bodily injury or property damage to a third-party organization. Tort liability means liability that would be imposed by law in absence of a contract or an agreement. So what we say here is the insured can agree to go so they can access to someone's premises that while they're on those premises, if anybody they take to that premises or anybody that might be on that premises gets damaged even from the negligence of the owner of the premises, if the insured held them harmless for their negligence, then that would be an insured contract, even picking up the negligence of the persons on the premises. So if the contract signs can become liable for the customer's negligence, there's more exposure here than an additional insured endorsement. In fact, the section 4 of this presentation will go in more depth, both in additional insured and contractual wording. Tort liability is a liability in law. That's when somebody has negligence. These contracts are included in hold harmless agreements. And so let's look at the exposure. Exposure consideration. It's covered if included in the definition of insured contracts. Therefore, when the insured assumes liability of another so they can access the premises, this is typically where it will be done, where a shipper or someone who arranges for the load says you cannot get on my premises to pick up or deliver loads unless you agree to hold us harmless for anything that might happen while you're on this premises loading and unloading, including even when we, the customer, causes negligence. That's the kind of wording you would have in those contracts. But there is a give back in this, and this is states have passed laws. They're called the anti-indemnification laws that says a shipper cannot require, it's against public policy for a shipper to require a trucker to hold them harmless for the shipper's negligence. This is recently new. It's in all states except the states listed here, and this listing is as of this date. These laws change almost monthly. Every month we'll see another state that brings this in. We had an example of this that I wrote a blog about a number of months ago, where there was an insured who had to sign a contract. Of course, it was to their largest shipper to get on the shipper's location. One of the drivers that they sent to pick up the load got injured by the customer's negligence on the customer's location. The driver sued the customer. The customer came back and said, motor carrier, you held me harmless so that you could access our locations. That whole harmless agreement included you holding us harmless for injuries to anyone that you took to the premises to accomplish the operation we required you to do. In other words, the loading and unloading of the vehicle. That person there got injured. Yes, it was our negligence. Our forklift ran them down, or they slipped on ice that we had there, or they sat in a pothole, whatever those things are that injured that worker that you had to take to the set. You agreed in your hold harmless agreement to hold us harmless for that, so please honor your hold harmless agreement. That would be an insured contract, and in absence of the anti-indemnification law, we would have to respond to that allegation or to that contract being placed back to the insured. However, in the state that this contract was drawn and the state where the injury happened, it did have the anti-indemnification law. However, the insurance carrier, I believe, when they addressed this claim, didn't understand how this works. It's still covered. The insured contract would still cover you. You might not have to pay because of anti-indemnification. So when the insurance carrier denied coverage to the insured, I felt that was a wrong approach here, because there is coverage. Even though there is coverage, we might not have to pay because of the anti-indemnification law. This was an important consideration in that now you don't have the trucker saying, whoa, I don't owe that because the law says I don't owe that, versus the insurance company of the trucker that would say, yes, you're insured, the trucker that you signed the contract with does have protection under their policy for this whole harmless agreement. However, the state that this contract was drawn in, or where the accident happened, the venue the contract was going to be interpreted on, has an anti-indemnification law. So therefore, even though we have it covered, we owe you nothing because it's against public policy for these contracts to be drawn. This is a major difference. In fact, a number of years ago, we had Gary Fulton from the Executive Vice President of the Colorado Trucking Association, to doing a seminar for us. He did an introduction, and I asked him in that introduction, would you please talk something about insurance? And he said, okay. And he started off saying the number one problem a trucker has today is the requirement of shippers to have the trucker sign agreements so that the trucker can access the facilities to pick up and deliver loads. That has been a major change in the last 5 years, because now this was an effort by the American Trucking Association to pass these anti-identification laws. For you who have other general liability courses, you would know that these laws are very common in the construction industry. But the anti-identification laws in most states only address construction, not transportation. So these address transportation. So much so that now when the American Trucking Association gets inquiries about this and they advise their truckers, they say, look, don't worry about signing these contracts. Go ahead and sign them if you're in one of these states with anti-identification agreements, because they cannot be enforced. There's a couple of things you need to look at if you're doing this, though, that takes some coverage away. It is common, particularly buying this in a non-admitted surplus excess lines market, to add an endorsement on the policy, CG 2139, which removes the 9F provision. In other words, remove the broad form provision. You need to watch this. If, in fact, the liability carrier, the general liability carrier that you write the policy with adds this exclusion to it, then you need to inform your insureds that they have no coverage when they hold other people harmless, and you need to ask them what contracts they sign to see if there are contracts that would cause a problem and come back later and having to be addressed, yet there's no coverage here. Most carriers will allow individual contracts to become insured contracts once they looked at them, but they take the blanket coverage away with the CG 2139, which is the redefinition of insured contracts, leaving the broad form out. There's also an endorsement, CG 2426, amendment of the insured contract. That modifies F. Instead of protecting the person the contract was signed with from their negligence, it would only protect them when they're held vicariously liable for the actions of the insured. This matches the additional insured provisions in the policy. So when you issue a policy, it's very important to understand from the insured what contracts they sign. In fact, I think that we fail to find this out. One of the things that I would suggest to you as you look at the policies to insure to write their business, ask them what contracts you're signing, who are your customers, what is the requirement for the customer to you so you can access their premise to pick up and deliver loads. Let us look at those contracts and let's make sure that we have your insurance coverage for those contracts. And after we issue the policy with this insurance company, we want to make sure the insurance company is willing to meet the requirements of your customers to get on their premises. This is a prudent thing to do from both the retail agent and the company, to discuss these things up front, because the first thing that the insured does when they buy a policy from you is the reason in most cases is it's driven by their customer, and they have to have proof of coverage before they can access the facilities to pick up and deliver loads. And therefore, when we deliver the policy, we need to make sure that we are willing to and able to meet their customers' requirements for insurance, or that policy that was purchased does not allow them to do business, which is a real problem, more so than even possibly the claims. So when we look at the contractual exposure, it will be in both the auto policy and the general liability form. The motor carrier exposure would be key stop agreements. Key stops agreements are agreements where the insured is making after-hour deliveries, most commonly in the gasoline area, where the insured has keys to the pumps or to the tanks in the ground. The motor carrier delivers the gas after hours, but while they're on the premises has agreed to protect the premises and to hold the insured harmless for anything that happens while they're unloading the gas. My father most of you know, or a lot of you know, that my father hauled pickles. But what some of you don't know, prior to hauling pickles, he hauled flowers for the Florida Fire Association out of Florida. In fact, Fort Myers, Florida, at one time was the gladiolus capital of the world. There are more gladiolus and pom-poms grown in Fort Myers than any other place in the world. Most of the property now has gone, or growing has gone to Costa Rica and other locations, just because it's cheaper to raise it there, and it's easy to transport it because they don't weigh much, so the air freight is not that expensive. In that case, though, my father had keys of a number of florists along the routes. So his driver would at night open the florist door, put so many package of gladiolus or pom-poms in the florist location, close the doors, and leave. But he signed an agreement with the florist that while they accessed their premise, while they unlocked the premise and had the premise open, they would hold the florist harmless for anything that could happen while they're on their premises. Very common for intermodal agreements. This is a requirement. You might make a note, though, in most states, the anti-identification agreements do not pertain to intermodal agreements. So you need to be aware that here the insured can assume liability of others, and that would not be fall under anti-identification agreement, and those agreements would have to be honored. The most common one, and the one that we just went through in detail, is to access the customer's premises for loading and unloading. So they hold the customer harmless to access the premises, and therefore when the contract requires the motor carrier to hold the customer harmless even for the customer's negligence, then that would be an insured contract. In absence of the modification, either the redefinition of an insured contract or the removal of that provision on the endorsements that we talked about, or exclusion we talked about earlier. All additional insured endorsements only cover the additional insured for their vicarious liability arising out of allowing the motor carrier to haul a load for them. The contractual harmless agreement can pick up not only vicarious liability, but also the liability of the customer if the customer's negligence damaged someone that the motor carrier took to the premises or other reasons. So there's more exposure in the contractual wording and whole harmless agreements than there is in additional insured from a coverage standpoint. Again, we'll go in more depth of that in Section 4 of this program. Liquor liability. Again, liquor liability is excluded. It's common here. But what we forget a lot of times is this applies only to, and that is the last paragraph here, this exclusion applies only if you're in the business of manufacturing, distributing, selling, or furnishing alcoholic beverages. So that does not exclude the host liquor, which is your insured has parties and other things. It excludes if that is their business. So host liquor is not excluded. So the trucker can have a Christmas party. The trucker can have a meeting of drivers. The trucker could have a customers meeting and serve alcoholic beverages to while there's people are at their premises to facilitate the customer relationship to keep the driver happy. However, my strong recommendation is I would be leery of a motor carrier who had a safety meeting and provided alcoholic beverages. That sometimes just goes against my grain thinking about those. But if this happened and somebody consumed too much liquor on the motor carrier's, the trucker's premises while they were having a party, and that person then has an auto accident and sues the motor carrier for their intoxication while on their premises that led to the accident. Therefore, the person, the inebriated person hit, could raise this suit, bringing the motor carrier into it. They would have coverage for this as long as they're not in the business of distributing, manufacturing, selling alcoholic beverages. There is a concern I had, and this goes back to the days where I insured this beer company, where the beer company hauled, or your insured could haul beer and alcohol. I don't believe that's distributing. However, if the case is bad enough, even from the party time we talked about, I do not want an insurance carrier to raise, oh, that's distributing, therefore you have no coverage even for the party time alcohol is served. So if your insureds are hauling beer or liquor, I would have a discussion with the general liability carrier to make sure they don't consider that distributing. There's really no problem here because every state law that I'm aware of requires a state license to deliver or to provide beer and alcoholic beverages to the consumer. A trucker does not have that license. Therefore, they're not in the business of selling or delivering product to the consumer. Therefore, where the consumer could have exposure from the consumption. But if you could argue that if they're distributing, you remove the host coverage, and that's what I do not think is prudent to remove, is the host coverage. The next two exclusions, D is the work comp exclusion, which we did not produce here. That is where the work comp policy comes in play. The general liability policies do not address it. The exclusion E is employee liability. The policy wording says, we exclude bodily injury to an employee of the insured arising out in the course of employment by the insured or performing duties related to the conduct of the insured's business or the spouse, child, brother, sister, that employee as a consequences of, again, the work before. This exclusion applies whether the insured may be liable as employer or any other capacity and to any obligation to share damages with or pay someone else who must pay damages because of the injury. So my question to you is, who is the employee that the insured uses? There are two situations where the insured could have workers that do not fall in the definition of employees, or would have workers where there's no work comp in place. We'll go in more detail in this later, but this is an essential consideration. In fact, we will do a future series of courses on work comp and OCAC that addresses this. If, let's say in some states like Florida, where you have to have more than 4 employees to require work comp to meet the state statute. A lot of states say any employee, but there's a number of states that have a numerical exception. So I have a driver, and I only have 3 trucks, and that driver is my employee. No question about an independent contractor. I pay him a wage, I deduct taxes, but I do not cover him for work comp because I don't have to cover him work comp in Florida because I'm not mandated yet by law. That worker, my employee, gets injured on my premises. They sue for those injuries. They were negligent. Let's say they fell down off of a loading dock because the steps were damaged. They sue me. When that employee sues me, my general liability policy would be called in to address it, but there would be no coverage under my general liability policy because they are an employee. So the general liability carrier would say, yes, that person got injured on your premises, but we owe, and you were negligent, but we owe nothing under your policy because they are an employee. When I teach this in a face-to-face situation, what I just remind the audience is now that employee of your insured owns the trucking company, or at least depending on the amount of damage, because there is no coverage. The key to this is if there was work comp in place, even not mandated by law, but I did decide to cover all of my employees for comp, then that employee could not sue under tort immunity provided by the work comp policy. I also remind you that maybe I decide to cover them with an OCAC policy, an occupational accident policy. Yes, now the worker would have some payment made when they got injured on my premises, but they still could sue. In fact, they not only could sue, their OCAC carrier could sue to seek subrogation back against me for being injured, you're insured for being injured on those premises. So be very careful here. The rule, in my opinion, is everybody needs work comp coverage to cover their employees unless they're a happy family member. And unfortunately, I've been divorced twice, and I know how far that goes. In other words, I want to cover everybody that works for me except maybe myself. The other scenario is that your insured has someone on those premises who is not an employee, but they're owner-operator, true owner-operator, buy their own truck, operate the truck, but lease to me. They come to my premise to either have safety training, safety meetings, have their truck inspected, pick up a paycheck, pick up dispatch or load certificate. While they're on my premises, if they get hurt, they could be injured. Again, they fall down off of a loading dock, or they step upstairs, the stairs break, or they slip on ice, or they get run over by a forklift or even a truck that the insured owns on those premises. In other words, the insured is negligence on the insured's premises. That owner-operator sues. Now, just the opposite of the previous discussion where the employee sues, now if the owner-operator sues, that would be covered under general liability policy because they're not an employee. So therefore, you've increased more exposure. Lastly, one other thing you see here, and we talked about this briefly in the contractual wording earlier, where you had your employee on someone else's premises, that employee sues the party that owned the premises that got hurt, but your insured has held that party harmless for any injuries, including of any worker or anybody that they bring to the premises to accomplish the task under the contract. And even that was the negligence of the customer, of the person they held harmless, would be brought up in absence of an anti-indemnification state. They give it back to you. Now what we have is, does this employee liability exclusion apply because we exclude bodily injury to an employee? Therefore, you need to read the last paragraph on this sentence. This exclusion does not apply to liability assumed by the insured under insured contract. So you would have to, as an insurance provider, address that employee suing the customer of the insured when the insured held that customer harmless, even for the customer's negligence. Here, you might not have to pay because of anti-indemnification agreements, but that would be considered an insured contract, and it would not be excluded. So if the insured uses only employees to accomplish their business and their work comp coverage in place, then exclusion D and E remove coverage from GL. You buy work comp. That's what it's for. That protects the employee-employee relationship. Therefore, they get defined benefits, but they cannot sue in a tort. But if not an employee, the worker, they could sue. So the problem with the insurers, motor carriers, using independent contractors, owner-operators, the independent contract owner-operator gets hurt on the premises, the exclusion does not apply. The exposure is, and a lot of carriers we're seeing who's writing general liability, motor carrier says, I don't want to write general liability if they use owner-operators. I see the exposure there. I clearly recognize that we increase that exposure by having owner-operators. However, realistically, what's on the premises? The examples I gave you earlier, there was something there that could hurt somebody. Loading docks, forklifts, steps, those kind of things. Yeah, ice pack, ice spots, potholes in the parking area. Yeah, if those things exist, then you need to worry about it, just like you would need to worry about if the Snap-on tool guy came and got hurt, or the customer comes to the premises of your insurers to pay or arrange for a load or to pay for a load. Look at that. If all that's there is a pay office where the owner-operator comes to pick up pay, there's no really loading facilities, there's nothing on the premises beyond just the place to walk into an office, then I think that might be overzealous of not wanting to write that general liability. But you need to look at this, but do understand that independent contractor on the premises would be more often to come to those premises have it. And the other thing, from an errors and omissions standpoint, be careful if you do not provide work comp for all the employees. Again, I'm not suggesting here the owner-operator is covered by comp because clearly they might not be. However, if it's a true employee on the states that have no numerical numbers of employees, or if your insurer just violates the work comp law of the state, then there's no coverage under general liability policy for those individuals. And remind you that also, getting back to the insured contract, if that worker, even employee, gets hurt on the customer's premises and your insurance agreed to hold them harmless, the customer harmless from the injuries to those workers, even caused by the customer, that would fall in an insured contract, and the insurance carrier, general liability carrier, would have to respond in absence of a anti-indemnification agreement. So consideration: hold harmless agreements in shippers, brokers, contract motor carrier. If an employee gets hurt on premises of a shipper and it was the shipper's fault, and the contract has the motor carrier holding the shipper harmless even for the shipper's negligence, then when employee sues the shipper tells the motor carrier to honor the hold harmless agreement. This is an insured contract, so therefore the exclusion for employee liability does not respond. So they must pay, or at least address the suit and pay in absence. They might not have to pay because of the anti-indemnification agreement. Motor carriers using owner-operators, more exposure under GL than auto liability for motor carriers using non-employees owner-operator. OC Act does not provide tort immunity, so without workers' comp, owner-operators can sue for their injuries on the premises. Some courts have held the term employee for liability coverage includes anyone operating a commercial motor vehicle for a motor carrier, even owner-operators, independent contractor. That is the definition found in FMCA regs and rules, and that is for safety purposes, but that only pertains to this individual operating a commercial motor vehicle. Once they get out of the vehicle and no longer operating it, now sometimes it goes to loading. Unloading has been defined as still operating it, so it might be not while they're just in the vehicle, but could be on the premises for loading unloading purposes. But now, once they don't operate that vehicle anymore, then the definition of employee does not fall back to the Federal Act, but would fall under the common definition of employee, which they would not be an employee. They would be an independent contractor. Therefore, the injured worker who's an independent contractor, owner-operator, would sue for their injuries, even with OC Act coverage, and that general liability policy of the motor carrier would have to address that suit. Again, what is on the premises? Exposure is accident at the location. What is there that can cause those accidents? Pollution. It goes in a lot of wording. The common wording in the pollution exclusions and jail policies is the most change in wording from year to year. Every time a lawyer finds an escape within the policy to find coverage for pollution damages done at a location by the insured or has a pollution loss, they modify the policy to take those coverages away where the court has ruled. Very briefly, there is we exclude bodily injury, property damage arising out of the actual, alleged, or threatened escape, disposal, seepage, migration, release, or escape of pollution at or from the premises, site, or location which is or was any time owned or occupied by a person or rented or loaned to any insured. However, this subpart does not apply to bodily injury from staying within the building and caused by smoke, fire, vapor. B, bodily injury property which is liable if you are a contractor and the owner-operator of the premises, site, location has added you policy additionally insured. But 3, bodily injury property damage from a hostile fire. There's basically no coverage for liability from pollution on or from the premises used or occupied by the insured. So anything that happens on the premises, there's no coverage. There's no coverage away from the premises if the insured took the pollutant there, except for a product exposure, meaning that if they sold items in a container, a 55-gallon drum, and the drum leaked, then they would cover. But also their exclusion does not apply to the fluids in the mobile equipment. This is very similar to there's no exclusion in standard ISO for pollution damage done by the fluids that make a truck operate, meaning diesel fuel, gasoline, battery acids, etc., hydraulic fluid. The same carve out of the exclusion also pertains to mobile equipment. It does not cover, it does cover hostile fire and fumes. So if the insured has their premises burned down and there's toxic fumes because things that are burning on those premises, chemicals and other things, and those items escape, then that exclusion does not, it does not apply. It does not apply when the fumes go to premises and hurt somebody away from the insured purpose. Therefore, it also does not exclude or cover any cleanup. So it's in a lot of terms called absolute, because the only two exposures you would have, one of which would beyond being a manufacturer of the product, but in trucking the only two exposure you have is the mobile equipment that they might have and the hostile fire for burning down. Other than that, pollution damages would be excluded. So for motor carriers, almost absolute. No coverage claims from pollution damage from insured's owned or occupied premises than coverage. Away from insured's premises, if pollution is caused by someone else's property that the insured does not carry to the location where the damage was caused. So if they run into somebody else's tank, they run into somebody else's stuff, but that would be in most cases an auto liability. I cannot think of much on the general liability in those areas, but there is some fluids, and that's in the mobile equipment. Form does not exclude fluids necessary for the operation of mobile equipment when equipment is away from the insured premise, not when they're on the premises, but when they're away from premises. So the real exposure here would be if your insured have mobile equipment. The most common one you would find is in a flatbed operation where the forklift that the insured carries with them is removed to unload the pallets of sod or mulch or steel or whatever from the forklift. And if that forklift turns over or leaks, for example, we actually had this claim whereas a forklift was unloading pallets of mulch, they hooked one of the hydraulic hoses, causing the hydraulic hose to come loose, causing fluids to escape from the forklift, damaging a lot of asphalt. That's covered because the fluids were necessary to move or to operate the forklift. So the real exposure you have from the pollution from where there is possible coverage is if you're insured to have mobile equipment. It could be the forklift we talk about, very common on flatbed operations, or if you're insured as a heavy hauler, they could have cranes, or you could have front-end loaders, or for dump operations, other things than that. Other than that, there's really no exposure for pollution coverage in GL, and by the same token, there is no coverage under the pollution, under the general liability policy for any pollution damage arising out of the insured premises. So, does the motor carrier have a pollution exposure? Yeah. Do they have service of fueling operations on their premises? Those items could escape. What do they do with the old oil? A lot of times in rural areas, I've heard the story, they throw the oil on the ground to keep the dust down. Well, that becomes a pollutant, particularly when the oil runs off. One of the largest uncovered claims I ever had was a beer company again, where the local Texaco dealership said, we'll put underground storage tanks in your facilities. We will not charge you for it. We'll fill it up there. You'll get a discount. And so after using this facility for 10 years and all those overflows, because we all know that we fill it up sometimes and you always have some spurting in, all that was washed into a low price on the location. The EPA came and said you must clean it up. $260,000. $260,000 the cleanup. It was uncovered because it was from the premises, no covered. Sometimes you're insured have washing facilities where they wash out trailers, or even sometimes the facility, the items they use to wash the trailers become a problem. Therefore, there's no coverage yet. You have an exposure. Do you or can you offer a standalone pollution policy? It's very easy to get. It's not all that expensive. It's mainly done through wholesalers and surplus line markets that you can access the pollution. I would suggest in any location that a trucker has any pollution exposure, again, service operation, fueling operations, washing facilities, that you talk to your, as a retail agent, talk to your surplus lines agency, or if you're a wholesaler listening to this, talk to your markets or see if you have a markets and offer those to the retail agents so they can offer to the insured. That's an important consideration for your errors and omission, because that product is available relatively reasonable in the marketplace. The only exposure that is covered there is the mobile equipment. I don't think that's much of exposure, because we're kind of used to that in trucking, with the idea that this is where the auto liability policy would cover pollution losses. But it's very common. Again, buying this coverage from a surplus excess line market is very common for retail agents to add CG 2149. This is a total pollution exclusion, meaning there's no pollution coverage. In fact, I read a couple of articles from a O standpoint, what's the difference in absolute and total? Because the current pollution exclusion in the policy has been called absolute. Now we put a total exclusion pollution on it. Basically what you're tucking away from is from the fluids that make the mobile equipment operate, mainly forklift for flatbed operations and the hostile fire, which I don't think is that much of exposure. So if your insured a flatbed, dump operation, or heavy haulers, then you have a concern if the total pollution exclusion, CG 2149, was added to the policy. So you want to watch that. If they're not involved in those operations, then I don't think there's any coverage in the policy, but I would recommend adding or trying to purchase the standalone pollution coverage. Exclusion J, property damage to property. It's not damage done by property, it's damage to the property that you own, rent, occupy, cost or expense incurred by you. 2, premises you sell, give away, or abandon. 3, property loaned to you. But more important, this has always been called under J4, property in your insured's care, custody, control. We've heard this quoted often, that there's no coverage for property in the insured's care, custody, and control. So, J, property damage, property insurance, care, custody, control. The motor carrier. We buy cargo policies, and the reason we buy cargo policies for for-hire trucker is that they have property of others in their possession. They are a bailee, and we buy a product that's called cargo coverage to buy back the care, custody, control exclusion and the auto liability policy. But that covers the cargo when it's in transit. It could cover beyond that, but you'd have to look at the cargo form itself, loading and unloading. So the exposure for this cargo, if you're a truckload carrier where you have a drop and hook operation, where the facility, the insured never takes the cargo to their premises, then you really don't have a exposure for that cargo that's not covered under the cargo liability policy. But when they're transporting, could they stop? That cargo might be extended coverage depending on the form. They could use warehousing or cross-docking. This is where they need warehousing coverage, meaning the cargo stays at the insured owned or controlled premises beyond the time limit that is allowed in the cargo form, typically 72 hours, not counting weekends, but you would need to look at those in every cargo form. So you have to address the exposure. When it's being transported, when it's in transit, then the cargo form that you write your insured buys back the care, custody, control exclusion on the auto policy. But does the insured have a terminal? Does the insured have a warehouse location? Does the insured have a location where trailers full of cargo are brought to those premises, and or the cargo is unloaded from those trailers and put on docks and other things? Then they have a warehousing exposure that you need to address. So it depends on their operation. Most truckers, cargo will cover them. It's mostly auto liability, but if you do have those facilities we talked about, then it could be falls under general liability because the cargo is not being moved anymore. Your insured still does not have coverage in the form called the care cost control exclusion, so you would need to augment or supplement the cargo policy to include this warehousing, other handling. Your insured can have owner-operators vehicles on the premises. To have to inspect, to look at, to work on, to store in those facilities. Therefore, this also is not covered in the general liability policy because that's covered in a garage keeper liability. That is an endorsement to the business auto policy. We also talk about other exposures. The building's not covered. This is fire damage legal. And the example that I used earlier is where your insured smokes. Your driver goes in a hotel room because they have to rest for the 10 hours after driving 11 and working 14, or we might be in a location where they have to stay at the hotel for the 34 hours restart. While your insured's in that hotel, they smoke in bed, they burn down the hotel. The damage to the room they're in would be covered under fire damage legal, and the damage to the hotel itself will be covered under general liability. That's how that would work, even though the property's in the insured's care, custody, and control. That is not excluded. But if they own the building, if they lease the building, then you would have to take care of that exposure by buying property coverage or modifying the lease. There's one more example here that I did not put in here on the outline that's also relevant. If your insured's a heavy hauler, a lot of times the heavy hauler has to assemble or disassemble what they're hauling. For example, they're hauling a bulldozer. The bulldozer blade has to be taken off to put on the truck. Once they get to the new location, the bulldozer is taken off the truck. Your insured reattaches the blade to the bulldozer, but does it wrong. The blade falls off. Again, that's a general liability exposure, not a auto liability exposure. Those are the exclusions we want to talk about. Very briefly, the policy also covers personal liability and advertisement liability. False arrest, detention, wrongful eviction. This is not much the motor carrier does unless you have a very aggressive driver that could take actions or use words, and therefore it might damage somebody in those ways that would not be the typical bodily injury or property damage. The form also provides med pay. This is payment expenses incurred because of an accident on your insured premise, and the key part of here is regardless of fault. The bodily injury pays when the insured is liable, so therefore you're going to cover it. It's when you take an immediate emergency, you don't want to worry about liability. The theory is that if I take care of the damaged person, I bandage them up, I send them to the hospital, I call the ambulance, they incur no cost, their health insurance carrier incurs no cost, therefore they won't sue. So this is an attempt to do away with suits. There are some exclusions we talked about that limit coverage. One of them is employee practice liability, CG 2147. Most truckers need to buy employee practice liability coverage. A concern that you have access to as a wholesaler or as a retail agent, you need to offer everybody employee practice liability. By adding the CG 2147 exclusion, most carriers I'm aware of add it. Don't tell us, or not at our request, but we add it, so therefore they need to buy that back, particularly with the new problems with the PSP, where the on-road actions directed by the dispatcher could impair their ability to have future employment. It might not, because that action that was caused by the dispatcher is now reported under their previous activities under PSP, and a new employer might not offer the job. We already talked about the CG 2149, the total pollution exclusion. Watch out for this, particularly if you're a flatbed operator, if your insured is a flatbed operator or has mobile equipment. We again also talked about the contractual liability, CG 2139, taking that broad form away. Insured signs a contract, then they would have no coverage when that contract holds their customer harmless. It might not be a problem if the contracts are going to be adjudicated in an anti-indemnification law states. The limits to coverage, each occurrence limit has you have each occurrence limit for med-pay, personal injury, advertisement liability, those things. But you also have a general aggregate and a products complete operator aggregate. Some ISO classifications do not allow for product and complete operation aggregate. Motor carriers is one of these classifications. So when you look at the trucker's classification in the general liability manual, you see two relevant things under the general liability. You have a P, which means payroll. So when you look at a trucker, the standard payroll, does driver pay, clerical pay, and sales pay do not generate premium. So what other employee does a motor carrier have? Until they have a garage repair, there's no one there that develops general liability premium. That's one of the concerns riding the smaller truckers, where you're going to get premium, because you do have exposure. The plus, the dagger, or the plus means there's no separate aggregate from product complete operation, only one aggregate. That the rule does require CG 2104 to be added, which takes away product complete operation hazard, but it doesn't take coverage away, it just takes the aggregate away. So on the deck sheet, what you want to show under the product complete operation aggregate is included above, meaning in the general aggregate limit, or NA, not applicable. So motor carrier needs general liability for libel and slander, protection of property from aggressive drivers, furnishing alcohol at Christmas parties or safety meetings. Contracts are big coverage. We'll talk about those in the next session. Leases of premises to run business out of, protection of persons or property, but not employees, then owner operator, independent contractor customers on the premises, burning down a hotel room, staying in due to running out hours of driver, the whole bit. Concerns: getting enough premium for exposure. Standard general liability does not include pay to drivers. Sales of personal. So standard general liability exposures for a smaller trucker, there's no one there that develops exposure, or premium, excuse me. No exposure develops premium. So insurance companies file a minimum premium somewhere, and look at the marketplace between $300 and $600, or they have filed a per vehicle, where you have so many vehicles to generate that. Additional consideration, because the smaller truck does not develop as much premium, not a lot of insurance carriers are willing to provide standard coverage, so a lot of it's written on a non-admitted basis. When it's written on a non-admitted basis, you don't be worried about the financial concerns of the non-admitted companies. They're, in most cases and most historically, financially sounder than admitted carriers. But you might have additional exclusions, limitations, or different means of developing premium. This is the third series of a 4 series. We hope you get something out of this from general liability for motor carriers. It's, again, so that the Motor Carrier Insurance Education Foundation's participants can be better apt to take care of their insureds, motor carriers. We're out of here. We look for you to take Section 4, which will be produced later. Thank you for your time.